Now on my channel, I obviously talk a lot about investing money. And the point of investing is to grow and maximize it, right? That's the whole essence why we invested in the first place. However, the question I get a lot actually is when people ask me, Kai, what actually should be my investment returns? And that's actually a really good question. Should be growing by 5%, 10%, 20%? It really depends on who you ask. But in this video, I aim to answer that question and the guideline whether your investment returns that you're achieving are actually good or to be improved going forward. And in my humble opinion, it's actually pretty straightforward. And for that, I'm going to use my self-drawn graph over here. And this is just to visualize you where I think you should be falling in. Now over here on this line, we have the returns, right? This is basically down here, 0% return, and up here, let's say 30, 40, 50. The higher you go, the higher the returns. And on this axis over here, we have time, right? Starting from the first day you invest, and then over time, the years go by. Now you see two lines that are highlighted over here. The first one being inflation. Now, we all heard about inflation a lot in the news, and it's one thing when you read about it, but probably all of us around the world, wherever you are, it's highly unlikely that you're not subject to inflation, because every time you go to the supermarket, you go to the restaurant, you travel, you feel things are getting more and more expensive by the day, it seems, and that's inflation, right? Your purchasing power is losing value. That means in the future, you need more of your money to buy the same thing. And obviously the last few years, it has been extremely high because in the past, it has been significantly lower. So it obviously fluctuates over the years depending which region we're in. But usually you can say inflation comes in at around 3%, right? So it's really a ballpark number. Again, this may differ from country to country depending where you live, but let's assume a base case scenario of 3%. In my eyes, that should be the base minimum return that you're making in order to maintain your money, right? Because if you wouldn't be achieving a 3% return, basically inflation would be higher than your return, which means that you are losing money. Your hard-earned money will be losing and become less valuable in the future, which I still see a lot of people struggle to get their head around. But it means if you keep your hard-earned money sitting in the bank without any interest on it, over time, it becomes less valuable because every month inflation is eating its purchasing power away from it. So therefore, you will need more money in the future to buy the same thing. You can see the same, for example, when you look at the house, right? You buy a house and then it goes up in value over time. You get excited because now your house is worth more, but actually it's still the same house, right? It just shows that there is a big part of inflation in there, that the value of money becomes less over time, which also has a lot of benefits in a way, right? If there wasn't any inflation, then people may not be spending as much. So there is a point to have a little bit of inflation, but I think it's very important to at least be outperforming inflation if you want to at least maintain your money. But ideally, of course, we want to be growing our money over time. And that's why I think that's really the base case. Anything lower than inflation level is really not good investment because here you're really minimizing and losing your money over time. Now, the second line you see over here is the S&P 500. If you've been watching my channel, I'm a big fan of the S&P 500. These are the 500 biggest companies in the US and most likely also globally dominating companies in many ways. And the S&P 500 had an average return over the last 30 years of between 8 to 10%, depending which publication you read. But let's just take the middle number over here, which is 9% return year on year. Now, granted, there are years when it is less, there are other years when it is higher, like the year we're in today, right? But overall, let's assume an annual return and growth of your investments of 9% if you were to invest into the S&P. So in this example, let's call it market returns. Now, obviously, depending where you live, you may want to be investing into the local index in your country where you live, right? For example, the DAX, the 40 biggest companies in Germany, right? If you wanted to do that, that would be your market returns, which probably will be lower than 9%, which might be 7 or 6%. So it depends on how you define the market. But in my eyes, I compare everything to the S&P 500. Anything that I invest in, if it's performing better, I call it above market performance. If it's returning lower than that, I would call it under market returns. And it's not the end of the world, right? A lot of people say, oh, I need to at least, outperform the market. And actually, it's really, really difficult. I mean, look at this. Just now in 2024, for the 14th year in a row, the S&P 500 actually outperformed majority. So more than 50%, I believe it was around 64% of actively managed US large cap stock funds. So these are actively managed funds with really smart people behind them. They charge quite a high expense ratio for their investors because they say, we promise you superior returns and so forth. Well, it turns out majority of them still underperformed the S&P 500. So that means their returns are less than the 9%, right? Year on year adjusted over time. And that's why I personally really think as long as you move between, those two lines somewhere, obviously your annual performance will fluctuate over time. You're doing a great job. If you really want to minimize that and make sure you're kind of really getting the market returns, well then guess what? You can just invest into S&P 500 ETF and basically follow that line, and you're going to be getting more or less your 9%. You're going to be on the safe side. Now, of course, I know a lot of you watching say, well, Kai, I'm really a smart investor. I'll outperform the S&P. I just recently invested in Nvidia and I made really good returns, 50%, what have you. So they're up here, right? Which is really great. And they think, well, I'm going to outperform the market. But again, look at the long term. And that's really the difference. Yes, if you got lucky with Nvidia, amazing. I'm really happy for you. But what are the chances that you will continue to outperform and find those hidden gems long term? Well, as I just shown you, it's very unlikely. And a lot of those investors, they either don't sell and take the profits. So once those companies often also resettle, right? We've seen companies doing extremely well in the past, like IBM and others. Those companies have come down really hard in recent times. And then often what you see, they have many years of underperformance of the market. They might still outperform inflation probably, but yeah, over time, they have kind of a hit and miss curve. And again, there's no right or wrong, right? It's your decision. But I'm just trying to illustrate the point that as long as you stay above the inflation line and closer towards the market returns, because realistically to outperform it over time is really, really rare case. There shouldn't be any pressure. Now, of course, we all aim to outperform it. And, I also have some Bitcoin holdings, which I personally hope will outperform the S&P 500 over time, which, maybe will be 10, 11, 12% over time adjusted. I don't know. I'm hoping. It's still a very young asset class. There's no guarantee for it. But long term, I'm really calculating with around 9, maybe if I'm lucky 10%, and that really works for me. But do keep in mind that even the S&P 500, as it shows over here, does fluctuate hugely on a yearly basis, right? You see here the annual returns with the dividends, so that's basically total returns, and you see here some years 1995, 37%, right? Then 22%, 33%, 28%. So massive returns, well over the 9% I just told you about. Well, but then we had the dot-com bubble, right? Back in 2000. Minus 9%, minus 11%, minus 21%. So you see, there can be years in a row of declining returns, and that's just normal. And that's why I really look at the long term, averaging it out over time. Once again, then you had a really nice recovery, 28% up, and it just keeps on going back. 2008 financial crisis, minus 36%. I mean, that's a big number to swallow, right? But that's why I invest in long term, because long term, I know I'm going to be coming back to the market average, which, as I mentioned, is around 9% over time. And you see this going on and just moves and cycles. So it's really normal. But why I'm saying this specifically, because a lot of people put a lot of pressure on themselves. Now let's take the example of Realty Income, which is a REIT, a real estate investment trust. It's a great company. I personally invested into this company quite a lot not so long ago. It's a great dividend paying company. The cool thing is they pay you a monthly dividend. Right now, the annual dividend yield is around 5.23%, which is amazing. And yeah, they've been paying and growing their dividends for the last 26 years. So really solid company, especially if you want to get passive income. It's amazing. However, why I personally sold out of them is when I objectively compared to the S&P 500 once again, which for me, as I said, is really the market benchmark, which I compare any investment. Doesn't matter, doesn't have to be stock related. It can be crypto, it can be real estate. Any investments that I do with my money should be measured against the S&P, because for me, that's the golden benchmark, which gives me an indication whether the investment I'm planning to make is a good one or maybe not such a good one. Right, so if I compare it in terms of total return, meaning including dividends, which obviously Realty Income has a lot, well, then you see a major stark difference, because over a 10-year period, and it's not even 30 years, just 10 years, S&P returned 228%, while Realty Income returned almost half that of only 116%. So when I saw that, for me, I was clear I wasn't maximizing my money. So basically, you could say the returns was somewhere below the benchmark. Let's call it, maybe towards the upper end, but around middle upper end of the scale. So I wasn't really getting the most out of it. And it would have been much easier to just stay invested in the S&P. But at the same time, it's still going to be a great investment for many people, because you're definitely still going to be beating the inflation rate, right? Your capital is growing because the share price has been at least staying stable or slightly appreciating over time. Plus you're getting the nice dividend, which, as I said, was around 5%. So let's be around, somewhere here, and slowly increasing over time. So they have been growing it continuously. So that's really attractive still for many people, right? Yes, it may not be as attractive in terms of total returns as the S&P 500, but at the same time, it's still really doing well for your money and growing your money, maybe slightly slower, but still contributes positively towards your total returns. Now let's have a look how those little percentages in terms of returns make a difference to your total portfolio over time. Now here we have an investment return calculator, and let's start off with an initial deposit of, let's say, $10,000, right? And again, can be euros, can be pounds, whatever your currency will be, but the logic is pretty much the same. Let's assume you make monthly contribution of $400, let's say $100 a week. Again, for some that might be very little, for others might be a lot. So again, I think it's just a fair number for most people that could be eventually achievable. The contribution could be either monthly or annually, but in this case, let's do monthly contributions. Number of years, 30 years. So we'll let it grow over a 30-year period because I think it's a realistic time horizon for many people. And again, I'm really a long-term investor myself. And that's what I'm really encouraging people not to trade, move in and out, but really let the money grow. The estimated rate of return for now, let's say 9%, which is the case of the S&P 500, and the compound frequency, we'll leave it at monthly. And you see, given those numbers, you're going to be reaching a total portfolio balance of $879,000, which again, I mean, given the small contributions we make every single month, is actually a really nice number. And the amazing part is, you see the difference here between the principal, so that's basically your contributions. So if there was no interest and there was no growth, you basically would have just let it sit there, put it in your bank or under your pillow. That would be the blue line. It's a very linear growth, right? Because every month you're just adding plus, 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 plus. Very straightforward, a linear growth. And that would only be 154,000. Still a nice number, right? But the major difference comes from the interest. You can see over here, that's 725,000. So that's the growth that you got from investing and having your money compound growth over time. That's the green line over here. And that's because of the 9% return or growth of your investments over time. So that's really what makes the difference. You'll see if I go back now to the minimum return that I said that you should be achieving, which would be 3%. But again, it depends in your case where you live. That 3% would only result of 257,000. So you would still have your principal, which would be exactly the same because that's basically linear addition of your $400 every single month. But then the interest, the growth that you got from your investments by having a compound in your favor over time is significantly less, actually less than the principal itself at 103,000. So that's really, I think, what should be the bare minimum for you if you wanted to invest. So basically that part over here, the difference between the green and the blue line, is what kind of offset the inflation, because otherwise, if you would have not invested that, you would have basically lost the equivalent amount to inflation, right? So I think that's the bare minimum when we talk about what kind of investment returns should I be expecting. Now, let's take a more realistic example, somewhere in between. In this case, let's go with 6%, and you will see a respectable number, just shy of $500,000. But once again, here you start seeing the interest, the growth basically that you generated with your investments, already double the principal at 308,000. So yeah, definitely it shows every percentage more that you achieve obviously will have a multiplier exponential effect on your portfolio size. But of course, let's look also at the very optimistic and bull case example. If you do manage to outperform the market over a 30-year period, which if you do, then honestly, you probably should stop watching my YouTube videos and start your own either channel or fund or education to teach other people how to outperform the market, because even most super investors aren't capable of doing so. But let's just, for the sake of this exercise, imagine you can do that at 12%, which would really be fantastic. You see a staggering number of 1.7 million. So a huge difference in terms of number. So that's just by 3 additional points over the average return of the S&P 500. So you see, the returns do matter. Every percent counts over the longer period, of course. But of course, at the same time, you can also tweak a little bit your contributions, right? So let's go back to market returns. And then instead of 400, and I imagine even if you start off with a lower contribution, maybe it's only 200 in your case, but over time, hopefully you start either building your own business or you start getting promotions in your job and start earning more. So hopefully, in your 30s or 40s, you'll be able to invest more than $400. So let's imagine as an average over the whole investment period of 30 years, let's say you manage to contribute $1,000 every single month at market returns. Now, all of a sudden, you'll be close to $2 million in your portfolio at the end of the 30-year period. So really a major difference over here. And now almost 5 times the amount of the principal comes in the form of the interest. So a huge difference, and definitely really nice to see that. Now, if I go down to only 7%, it's still 1.3 million. So it's really two components: is your estimated rate of return, but of course also your contributions that really make a difference. And that also nicely brings me to the last point, which I really want to make sure you understand, and that's not to overly focus on your returns. Now, granted, it is important to outperform inflation, and obviously you want to get as close to the market returns as possible. But at the same time, I see a lot of people, especially early on when they're young or just starting to investing, they're taking too aggressive risks and invest the little money they have aggressively into really high risk investments, which I really personally could not recommend, just to outperform the market. Now I get it, because obviously they have less money to invest. Even if you lose the money, it's not that bad, because it's just a little bit and you have more time to recoup. And well, while I get it, at the same time, I think it's just important to start building that muscle of dollar cost averaging every single week or month into a solid investment. And rather than trying to outsmart the market, trying to find the winning company in the future, which we just saw is really difficult. Most people fail to do that successfully over time. Why don't you just automate, go with the market returns? We've seen at 9% return over a longer period, you're going to be having an amazing portfolio over time. And rather than trying to bring your investment percentage returns up, spend more of your time trying to increase your earning potential, because I think that will really help you to further grow and build a stronger and bigger net worth over time. So either try to get a job promotion to get a higher salary paid to you, or maybe start thinking of having a little side hustle on the weekends or after work, before work, that brings in a second paycheck or income for you, that you have more money to invest. If you have your own business, maybe find ways to focus and double down how you can increase your revenues for the business or increase your profitability so you make more money from the business and once again have more money to invest. So in my humble opinion, trying to increase the rate of return, yes, we all want that, but it's going to be very hard at a certain point. Trying to be consistently higher than the S&P 500 is almost impossible over a long time period. Plus, it will take a lot of your time to research all the things and stay up to date with the market and so forth. So I personally really recommend focus on your contribution amount to start increasing that over time, because that can really exponentially grow your portfolio, while you can lean back and passively invest your money into a low-cost ETF such as the S&P 500 that I buy myself. Hope you found the video useful. If you did, then please give it a like. It helps the video to be seen by more people. And if you still have any questions about any of the things that I mentioned in this video, pop them down in the comments below. I'll get back to every single one of you. Next up, check out this video right here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.